this short video will explain what investment and funding strategies are and why they're important in helping a company manage its money wisely. Let's start with investment strategies. So these are about how company uses extra money to earn more. The goal is to get returns while still keeping enough cash available and avoiding too much risk. For example, they might invest in short-term bonds or low-risk funds saved, but still helpful for making profit. Next, funding strategies are about getting the money a company needs to grow or operate. These can include borrowing from banks, selling shares, or using saved profits. The key is choosing the best way that's affordable, low risk, and keeps control. So in simple terms, using the right investment and funding strategies helps a business grow, stay strong, and reach its goals.
Today, I'll walk through the key objectives, types of instruments, and influencing factors that shape effective investment strategies for organizations. To start with objectives of investment strategies. When we talk about investment strategies, three primary objectives guide our decisions. First, preservation of capital. Second, liquidity. And the third is yield or return.
Preservation of capital. The foremost goal is to protect the principal amount invested. This is especially important for organizations that cannot afford to lose their core funds, such as those fiduciary responsibilities or short-term obligations. Liquidity. Ensuring that those funds are readily available when needed is critical. Liquidity allows a company to meet operational or unexpected needs without incurring losses for forced sale or penalties. Yield or return. While safety and liquidity are essential, generating a reasonable return on investments is also a priority. The level of return pursued depends on the company's risk appetite and investment horizon.
Types of investment instruments. To achieve these objectives, organizations have access to a variety of investment instruments. There are the cash and cash equivalents, short-term investments, marketable securities, and other investments.
Cash and cash equivalents. These are highly liquid assets such as bank deposits, money market funds, and treasury bills. They offer safety and immediate access to funds, making them ideal for short-term needs. Short-term investments. Instruments like commercial paper, certificates of deposit, and repurchase agreements mature in less than 1 year. They typically offer higher returns than cash equivalents but still maintain a high degree of liquidity. Marketable securities. These include stocks and bonds that can be easily bought or sold in public markets. They provide the potential for higher returns but may come with greater risk and less immediate liquidity compared to cash equivalents. Other investments. Depending on the company's risk profile and investment policy, the category can include alternative assets such as private equity, hedge funds, or real estate. These investments may offer diversification and higher returns but are generally less liquid and carry higher risk.
Factors influencing investment strategies. Several factors must be considered when designing and implementing investment strategy. There are risk tolerance, investment horizon, liquidity needs, market conditions, and regulatory environment.
Risk tolerance. This is the level of risk the company is willing and able to accept. It shapes and selection of investment instruments and the balance between safety and return. Investment horizon. The time period for which funds are available significantly influences investment choices. Longer horizons allow for higher risk, higher return investments, while shorter horizons require more conservative, liquid options. Liquidity needs. Immediate and future cash requirements dictate how much of the portfolio should be allocated to liquid assets versus longer-term investments. Market conditions. Factors such as interest rates, economic outlook, and market volatility impact the attractiveness and performance of different investment options. Regulatory environment. Compliance and regulations and accounting standards is essential to avoid legal and financial penalties. This can also limit the types of permissible investments.
Funding strategies. are about how a company raises the capital it needs to finance its operations, investment, and growth. We have four types of objectives of funding strategies. First is access to capital, securing the necessary funds to support business activities. Second is cost of capital. It is minimizing the cost of borrowing or raising equity. Third is financial flexibility, maintaining the ability to access capital in the future. And lastly, we have capital structures optimization. It is balancing debt and equity to achieve the optimal capital structures.
I'd like to discuss the main types of funding sources available to companies, as well as the key factors that influence funding strategies. Types of funding sources. First, let's look at the different ways companies can raise funds. There are equity financing, debt financing, internal financing, and the other financing sources. Factors influencing funding strategies. Now, let's consider the influences a company's choices of funding. There are cost of capital, financial leverage, company stage of development, market conditions, and the company's credit rating.
Cost of capital. Every funding source comes with a cost, whether it's interest paid on debt or expected return for equity investors. Companies aim to minimize their overall cost of capital to maximize profitability. Financial leverage. This refers to how much debt companies uses. While leverage can boost returns when things go well, it also increases risk, especially if cash flow is unpredictable. Companies' stage of development. Startups often rely on equity financing because they may not qualify for loans. As companies mature and build a track record, they often take on more debt to optimize their capital structure. Market conditions, interest rates, investor sentiment, and the overall economic outlook all affect the availability and attractiveness of funding sources. For example, high interest rates can make debt less appealing, while strong market might make it easier to raise equity. Company's credit rating. A higher credit ratings means a company can assess debt at lower interest rates. If a company's credit ratings drops, borrowing becomes more expensive, and it may have to rely more on equity or internal funding.
Good day everyone! Today I'll be discussing a critical component of effective treasury management, the integration of investment and funding strategies. In a well-managed organization, treasury is not just about keeping the lights on, it's about ensuring the business has the financial agility to grow, compete, and respond to change. This is where integrating investment and funding strategies becomes essential. First, cash flow forecasting is the foundation. Accurate forecasting of cash inflows and outflows helps us anticipate funding needs and identify the right moments to invest excess cash. Without this clarity, we risk either running short or leaving money. Next, liquidity management. This is about maintaining enough cash or liquid assets to cover short-term obligations while avoiding excess liquidity that could be more productive elsewhere. Then we have risk management. When we talk about investment and funding, we're also talking about exposure, whether that's interest rate risk, credit risk, or currency fluctuations. Actively managing this risk protects our financial stability. Finally, strategic decision making. Investment and funding strategies should not exist in a silo. They must align with the company's broader financial goals and long-term business objectives. Every decision, whether it's securing a loan or deploying surplus cash, should move us closer to those goals. In summary, by integrating these elements, forecasting liquidity, risk, and strategy, companies can not only optimize how they use their financial resources, but also manage risk more effectively and stay on track toward their financial goals. Thank you, and let's dive deeper into each component.